There are concepts like PE ratios, price to book value, debt equity ratio, which people look at when they want to select a stock. I just want to highlight the fact that one should not look at all these things in isolation. One has to have a holistic picture about all the things. To give you an example, a straight example, there have been PSU stocks which have been trading in single digit PE ratio since the past 10 years, since a decade now. So does that mean that the PSU stocks are cheap or they are at a bargain? They have been trading at a bargain for 10 years. JSW Steel compared to SAIL, JSW Steel has been trading at a 8 P ratio compared to a SAIL which has been trading at a 3 P ratio. Now if I compare the returns of both the stocks, JSW Steel has returned 22% compared to a SAIL which has returned 5% in the past 1 year. So in this case, a higher P ratio has given a better return. Another example on the flip side is a lower P ratio giving a better return. State Bank of India at 12 P ratio has returned 51% in the past 1 year compared to ICICI Bank which has returned 30% over the past 1 year with a 24 P ratio. So one has to look at the holistic picture. If you look at Emphasis, L&T Technology Services, which is LTTS, and Tata Elxsi, all three belong to the same industry, are roughly of the same size. If I look at the debt equity ratio of these companies, Tata Technology, the ratio I'm talking about, Tata Elxsi is having the minimum debt, the lowest debt. 0.8 is the debt equity ratio of Tata Elxsi. It has returned more than 100%, around 170% in the past 1 year. Second best returns among these three is Emphasis, which has returned 77%, but its debt equity ratio is 3 times that of Tata Elxsi. So does that mean a lower debt equity ratio ensures a better return? Not necessarily. If you look at LTTS, it has also returned 67%. So again, the point is these ratios represent the figures which have already been established. These figures are actually the history of the company. They have been established. The stock market does not look at the history. It looks at the future and tries to discount the future. So what one has to do is look at all the figures, look at a holistic picture, have a bird's eye view, don't go too much into the details, and have a view and act on the highest probability view. That is what we have to look at when we look at these ratios or other fundamentals or other technicals. We have to look at everything on a holistic picture and try and discount the future.